In 2001, this company was one of the biggest accounting firms on the planet, earning billions of dollars a year, trusted by half the Fortune 500. Then a memo went out, one that looked completely routine on the surface, and it became part of a chain of events that helped accelerate the collapse of a 90-year-old institution in under a year. This is the story of how paperwork, panic, and one badly timed piece of legal advice combined to help bring down a business empire, and why the real story is messier than the simple version you usually hear. Let's rewind. Arthur Andersen wasn't some sketchy startup you've never heard of. Founded in 1913, it grew into one of the Big Five, the 5 accounting firms that basically ran the financial world. If you were a massive company and you needed someone to check your books and say, "Yep, these numbers are real," you called Andersen. They audited energy companies, phone companies, airlines, half of the Fortune 500. Their stamp of approval was basically a gold star that told investors, "Relax, this company isn't lying to you." By 2001, Andersen was pulling in over $9 billion a year in revenue, at a time when a young company called Google was still just getting off the ground. Andersen wasn't just big, it was a financial fortress, built for almost 9 decades by a guy who literally started his career as a mail boy. This was not a house of cards, or so everyone thought. Now here's where things get spicy, because Andersen had one very important client, Enron. You've probably heard the name. Enron was an energy company that looked like a genius on paper and turned out to be one giant magic trick, hiding billions of dollars of debt using accounting tricks so complicated that even some of their own employees couldn't fully explain them. And guess who was signing off on those books every single year, telling the world everything checks out? Andersen. By October 2001, the walls were closing in. The Securities and Exchange Commission, basically the financial police, sent Enron a polite little letter that said, "Hey, we have some questions about your accounting." Translation: you are in serious trouble. And because Andersen was Enron's auditor, that meant Andersen was about to get pulled into the fire too. So what happens next? On October 12, 2001, an in-house lawyer at Andersen named Nancy Temple sent an email reminding staff of the firm's official document retention policy, standard language about which files needed to be kept and which could be cleared out. On its own, a fairly ordinary memo, but the timing was terrible. And in the days that followed, documents at Andersen's Houston office started disappearing at a staggering pace. We're talking tons of paper shredded, nearly 30,000 emails and computer files connected to the Enron audit, deleted. Picture a library catching fire, except nobody's trying to put it out. Everybody's throwing more books in. Why are we shredding so much right now? Company policy. Right now? During an SEC inquiry? Company policy. That memo didn't order anyone to destroy evidence, but investigators later pointed to it as part of a bigger picture, one piece of a puzzle showing that Andersen's own legal team already sensed serious risk on the horizon. And here's the twist that makes this story wild. The shredding didn't stop because someone grew a conscience. It stopped because on November 8, 2001, Andersen got hit with an official subpoena demanding those exact documents. The very next day, an internal email went out that basically said, "Okay, stop the shredding now," which is possibly the most useless instruction in corporate history, kind of like telling someone to stop eating the cake after they've already swallowed it. By the time regulators pieced it together, only a small fraction of Andersen's workforce out of tens of thousands of employees worldwide was actually involved in the shredding. But in the eyes of the law, and more importantly, in the eyes of the public, Andersen wasn't a company where a few people made a bad call. Andersen became the company that destroyed evidence. And once that label sticks, good luck scrubbing it off. March 2002. Federal prosecutors formally indict Arthur Andersen for obstruction of justice. Not one employee, not one department, the entire firm. Their CEO resigned within weeks. Clients, the same massive corporations that had trusted Andersen's signature for decades, started running for the exits, because nobody wants their books audited by a company that might be a convicted felon by summer. Then came June 15th, 2002. A jury delivered the verdict, guilty. Arthur Andersen became the first accounting firm in American history ever convicted of a federal felony. And here's the part that turns this from bad year into instant death sentence. Once a firm is a convicted felon, it's legally barred from auditing public companies. For an accounting firm, that's not a punishment, that's a lobotomy. Auditing public companies was basically the entire business. So, on August 31st, 2002, Arthur Andersen surrendered its license and stopped auditing public companies for good. A firm that had survived the Great Depression, 2 world wars, and nearly 9 decades of economic chaos saw its collapse accelerate rapidly through 2002, driven not by a market crash or bad investments, but by shredded documents and a felony conviction that made the company practically unemployable. Around 85,000 jobs worldwide disappeared. Accountants, secretaries, junior staff who had nothing to do with Enron and had never even met Nancy Temple, out of work within weeks. Entire offices in cities that had nothing to do with Houston gone, because the brand itself had become radioactive. Now, here's the plot twist almost nobody remembers. In 2005, 3 years later, the Supreme Court reviewed the case and unanimously overturned the conviction 9-0. But before you get excited, this wasn't the court declaring Andersen innocent of everything. The justices ruled that the instructions given to the jury at trial were too vague to properly support a conviction for obstruction. It was a technical ruling about how the case was argued, not a verdict that nothing wrong had happened. So wait, they won in the end? Legally, the conviction was wiped off the books, so the company got to come back, right? Big comeback story? Nope. By the time that ruling came down, it didn't matter anymore. From tens of thousands of employees at its peak, down to only a couple hundred people left. Just enough to handle leftover paperwork. You can't unring a bell that loud. The verdict got reversed, but the company was already buried. Some pieces of Andersen did survive, just not as Andersen. Its consulting division had split off years earlier and became a company you've definitely heard of, Accenture. A group of former partners later launched a smaller, tax-focused firm that still exists today. But the accounting giant itself, the almost 90-year-old institution that once dwarfed a young Google in revenue, was gone. So what actually killed Arthur Andersen? It wasn't Enron's fraud alone. Andersen didn't invent Enron's fake numbers. What killed Andersen was everything that piled up after. The shredding, the deleted files, a memo that became part of the evidence, and a legal system that moved fast enough to end a 90-year-old firm before all the facts could even be fully untangled. In the end, it wasn't just the crime that ended Arthur Andersen. It was the chain of legal and reputational damage that followed once the world started watching. And maybe that's the real lesson buried in all that shredded paper. In finance, in business, In basically anything, it's rarely one single mistake that destroys you. It's the chain reaction of what happens next.